Good morning, everyone. Thank you for joining us for today's webinar, State and Local Tax Considerations for Manufacturers with HBK Manufacturing Solutions. Today's presenter is Tim Adams, Principal and National Director of State and Local Tax for HBK. I just have one housekeeping item that I wanted to review with everyone. If you are in need of CPE credits from today's session, please make sure you stay in for the entirety of the session and answer 3 poll questions. There are 4 total, but you only have to answer 3. A certificate will be mailed to you in about a week for your credits. And now I'll turn it over to Amy.
Thanks so much, Lori, and good morning, everyone. Welcome to our next webinar in our series for manufacturers. As Lori mentioned, today we have a very special speaker with us, Tim Adams, who is a principal who sits in our Pittsburgh office and specializes in state and local tax. We are very excited to have Tim on board with us today. We have seen a lot of manufacturers, especially recently, who have had concern regarding some of their state and local tax obligations, whether that be what to do, maybe there's a compliance issue and how to resolve it, how to make sure that they're meeting their obligations and so on and so forth. So we felt this webinar and this information was extremely well timed, and hopefully you will find it beneficial as well. As Lori mentioned, there will be a few poll questions throughout today's presentation. Please make sure to answer those if you are in need of CPE credit. We'll also pop in with some questions from manufacturers that we have heard to make sure that some of those items that may be top of mind for you are addressed today. So with that being said, again, I welcome everyone and turn it over to Tim.
Okay. Thank you, Amy, and good morning, everybody. And welcome to our 1-hour webinar. And hopefully we've pulled together some information that is pertinent to all of you. And we know when we talk about some different developments, whether it's a state or a particular issue, it may not apply to all of you all of the time, but I think most of these are things that would be good information you to be aware of and take consideration of in your manufacturing business. So with that in mind, we're going to start today's webinar and just go through a little bit of the intended agenda. And obviously, as Lori started out, if there's any questions, please let us know. And if there's anything at the end of the presentation, feel free to reach out to me via email or give me a call, and we'll be glad to discuss. But today, what we're going to look to take a little path at is just give you a little flavor of where we think the state of the states are, with many of the states issuing new budgets during the summer months and any type of development there. Also highlight to you some specific state and local tax developments for Ohio, PA, and some of the other states that we have a footprint in. And then we're also going to move on to where we think are areas of opportunity as well as consideration for manufacturer based upon developments, but also based upon things that apply to manufacturers that have been in place for years and decades, and just want to kind of highlight some of those things so they don't get lost in the shuffle. And then also just kind of run through some pass-through entity tax overview, kind of let you know what the states are doing now. This continues to be a big focus of state legislatures in terms of trying to address the infamous SALT cap that was put in place during the Trump administration under the TCJA that had the limitation for state and local taxes of $10,000. And then at the end here, we'll wrap things up. So before we get to the information, we are going to start with a poll question to confirm your attendance. And as I said here, we're going to just talk a little bit about the state of the states. Typically, you do see some consistent trend lines, going into new fiscal years with the states. And there's a lot of talk out there of the slowdown of the economy, a potential recession, things of that sort. And the bottom line is, that is true, but there's still states that are, exhibiting a strong fiscal position. And from the state and local tax perspective, we always think that's a good thing, because when the states, are not exhibiting a strong fiscal position, the first reaction usually is, how do we get more tax revenue, whether that's increase of rates or legislative changes, or going out and trying to audit individuals and businesses. So, a strong fiscal position is being exhibited by, many states, and we think that's a good thing, and hopefully that's something that continues. The other thing that we have seen that may go against that just a little bit is, when COVID was in place and there was some slowdown, there were some states that, did have an increase of tax rates and temporary surcharges, and some states, not a lot, but some states have chosen to keep those increased tax rates in place, as well as some of those temporary surcharges, and we'll talk about one of those states in the state local tax development side of things. And that's not uncommon. You like to see those temporary rate increases not stay, but obviously I think states do have the appetite for higher revenue rather than decreased expenditures. And also going to go through some of the states that have had some significant legislation, as well as other developments that apply to our region and where you have business activity. And as I said, also we will cover a little bit of pass-through entity taxation developments, and that remains a big focus of state legislatures, where states are trying to get something in place that does not penalize people with the $10,000 SALT cap. So we'll kind of run through and highlight to you kind of where states are in terms of trying to develop a mousetrap that can circumvent that SALT cap that was put in place under the TCJA. And then the other thing that we'll talk a little bit about is economic nexus. And again, that's where we're speaking of states choosing to subject people to tax that do not have a physical presence in the state. And many of you are aware that there was significant changes on that front on the sales tax side, and now we're starting to see some of that develop on the income tax side, and that's no surprise to anyone. When states can see that, hey, we can subject more and more taxpayers to sales tax under economic nexus conditions, they're going to look to apply that playbook to income tax purposes as well. Okay, so let's talk a little bit about some of the developments here on the commercial activity tax side of things in Ohio. And one of the things that Ohio has put in place here is the elimination of the annual minimum tax for periods after January 1 of 2024. There also will be a increase of the CAT exclusion amount to $3 million for 2024, and then $6 million for calendar years 2025 and beyond. So, that's saying that beginning with the 2024 tax year, taxpayers with calendar year taxable gross receipts less than these exclusion amounts will not be required to file a tax return. And that's what, Ohio had intended with the tax, the commercial activity tax, to have in place, from the beginning, where it's a, tax that they're trying to obviously put on some of the bigger volume businesses that have sales activity in Ohio, and avoid having a lot of the companies that have smaller revenue amounts paying that tax. And then also beginning after the 2023 annual return, the annual filing is no longer required, and only the quarterly CAT tax return will be required to be filed on or after January 1 of 2024.
So Tim, with those changes,
yes.
are there anything that our manufacturers should be doing now? Do these changes just go automatically into effect? Is there any preparation they should do within this last quarter of the year?
Well, I think the main thing that I would focus on is many of these changes are automatic. I think they just need to be aware of does the minimum tax is not a significant tax, but that could be something where a lot of taxpayers are able to avoid being subject to the CAT, and just be aware that some of these exclusions are going up, and therefore there may be situations where people more and more people don't have to file the CAT return, but they will all be in place. The one development that I would highlight that applies to companies that they should be making ultimate paying attention to is a decision here on the sourcing of the receipts under the commercial activity tax. And what I wanted to highlight here was there were two recent decisions with the Ohio Board of Tax Appeals, VVF Interest LLC and Jones Apparel Group, 9 West Holdings. And essentially what happened here was there was a extra, what we would refer to as an extra statutory requirement that basically sellers would have to know where the ultimate final destination of the goods were at the time of sale. And you can think about that as, a lot of times folks can, be making a sale that could be apply under the commercial activity tax and not know ultimately where the, ultimate consumer is. Someone might be purchasing it and then, reselling it to somebody else. And in the past, the state of Ohio has required the seller to know that ultimate destination of the goods at the time of sale, and pose a very, very significant challenge for a lot of taxpayers to know. Say, hey, is this staying in Ohio? Is this going out of Ohio ultimately? And caused a lot of angst and uncertainty with taxpayers. So these two recent decisions by the Ohio basically makes things a little bit easier by removing that extra statutory requirement that a seller knows that ultimate destinations. They don't have to know where it ultimately goes. They make their good faith effort of understanding where their seller is that they're selling to and where they're shipping the goods to. That's makes life a little bit easier. And in some cases, if Ohio is trying to still require that under audit, or if taxpayers continue to do that, there are possibilities for refund opportunities to have less of your sales subject to the CAT based upon this decision for cytosine and not having to know exactly where ultimately these goods go. And this development here is highlighted in the Ohio Revenue Code that we share with you at this point. The other thing that we wanted to talk to you a little bit about on the Ohio development side is a couple things. One being is Ohio is allowing Ohio resident a tax credit for pass-through entity taxes paid to other states. Taxpayers, have had to add back PTA PT taxes paid to other states and deducted from an individual's federal adjusted gross income and determining taxpayers' Ohio adjusted gross income. This new rule generally applies to tax years on or after January 1 of 2023, but taxpayers may apply the credit to their Ohio returns for years ending on or after January 1, 2022 on an amended or original return. Prior to this change, the Ohio residents were precluded from claiming a resident credit because the tax was deducted from an individual's federal adjusted gross income. So this is a good development and change for Ohio residents. And the one thing that we will note, though, is it's anticipated that the Department of Taxation won't revise the 2022 individual income tax forms, but will issue guidance to identify how a taxpayer may claim the resident credit on their 2022 individual income tax returns. So that's something to be on the lookout there for. The other thing I would highlight is in Ohio, the income tax brackets, have been reduced from 4 to 2. The top brackets, going from 3.99% to 3.75 in 2023, and then 3.75 to 3.5 in 2024. Also, Ohio has identified as far out as August 1 of 2024 that there will be a sales tax holiday. And as we get closer to 2024, the state will lay out exactly, what will apply to the sales tax holiday. And a lot of times this is timed in conjunction with back to school, college and high school and all levels. So a lot of those things are often exempt, but we'll wait and see, and we'll update you here as to what will apply to the sales tax holiday in 2024 in Ohio. The other thing I was going to mention and share is that there was a development with employers with remote employees. They're now allowed to use an alternative apportionment formula for the net profit tax. And essentially, what Ohio had done there is that the alternative apportionment election is available for taxable years ending on or after December 31, 2023. And this optional formula permits employers to source sales, payroll, and property to a designated reporting location that is owned or controlled by the employer or the employer's customer rather than the employee's remote work location. This does not change, an employer's obligation to withhold the tax, but at the bottom line, it just does give employers a different way of apportioning for the net profit tax there. So let's go on to developments in the neighboring state of Pennsylvania. And the first bullet here is a very quiet summer. And basically what that describes is that Pennsylvania had a new incoming governor on the Democratic side, and for a number of terms here, Pennsylvania has had a Democratic governor, and then both the House and the Senate controlled by Republicans. And a lot wasn't done based upon the differing tax philosophies and objectives of the Democratic governor and the Republican House and Senate. And there was some thought that there was going to be some working between the Democratic governor and the Republican legislators. And what created a very quiet summer was one of the houses flipped very narrowly to the Democratic side based upon some late elections and replacements. And two, there was a difference of opinion as to what the new governor was willing to do in terms of tax policy. And the Republicans felt that there was basically some backtracking on exactly what was agreed to, promised to, and basically the Senate Republicans went home for the summer. And the bottom line is that there has been no tax legislation done relative to the budget. When the Republicans and Democrats came back to Harrisburg in late summer, early fall, they did pass kind of the narrow, the minimum that was needed to keep the government running. But there basically has been nothing done on the tax side of things. What I will share with you was recently there was a list of Democratic wishes on the House side that you can see, expansion of a lot of credits, combined reporting, where PA remains a separate company state, acceleration of the CNI rate decrease, and as well as increases in the NOL cap. Most people feel that that's going nowhere. It was just kind of the Democrats flexing some legislative muscle. But the bottom line is, it's been all quiet on the tax legislation front in Pennsylvania. The only other thing I would highlight to you in terms of other developments is that there continues to be court cases on the PA NOL cap, and that's where PA has had various cases where people have fought the percentage NOL cap, the fixed dollar amount, things like that, and that's still getting hashed out in the courts. And there continues to be a case with Alcatel, Lucent USA, and basically that they are appealing to the PA Supreme Court that the PA court properly applied recent precedent when it ruled that applying a flat dollar cap to Alcatel Lucent's net loss deduction violated the state constitution, and they were entitled to a $4 million income tax refund. So the NOL cases continue to get hashed out. And the simple reality there remains is that there is so much at stake in terms of tax dollars for these NOL cases that depending on how the courts decide them, could really put a serious dent in the fiscal viability of the Commonwealth in Pennsylvania, because there's just a lot of tax dollars at stake if taxpayers were entitled to greater NOL relief. The only other things I would highlight to you on the PA side, if it applies to you, is that PA did recently come out with an updated corporate tax bulletin 2008-03, and that was an update on net loss deduction limitations under Internal Revenue Code 381 and 382. And then there was also a corporation tax bulletin 2019-03, which talks further about Pennsylvania's corporate net income treatment of Internal Revenue Code Section 163J. So that's what's going on the PA side of things. In terms of New Jersey, New Jersey has had some significant developments, and they are probably one of the states where we would say has had significant legislative developments. And one of the things, and doesn't apply to all on the call here, but they did have some significant changes for the corporation business tax for periods ending on or after July 31st of 2022, to changes to a net deferred tax liability deduction for combined groups, also requiring worldwide combined groups wherever located or formed, and then also some further clarification of their treatment of Internal Revenue Code Section 163J. The only other thing that I would highlight to you, and this is going to show you what I was alluding to early in our discussion in terms of economic nexus. And as I said to you that, once the states saw, how basically every state that has a sales tax adopted economic nexus after the Wayfair decision in 2018, many of our discussions that we've had with clients and directly and through the webinars is that we anticipated that the states would then start looking to apply economic nexus to income tax, just because, again, it increased sales tax collections, and they would like to have the same for the income tax. So New Jersey actually has put in place a bright line nexus standard that basically says that in the past, people had to have a physical presence in a state to be subject to sales tax, and that's no longer the case. But now, that applied to, in a lot of cases, to income tax purposes. But New Jersey is another state here that they put in a new standard here, and basically said is that if you have receipts from sources within New Jersey in excess of $100,000 or more, or 200 or more separate transactions delivered to customers in New Jersey, you're going to be subject to the corporation business tax in New Jersey. So again, this is just a little hint of what's to come in terms of states looking to subject taxpayers to tax in their state, even though they may not have physical presence. So just keep that in mind, and that's a trend that we will continue to talk about in the coming years. The other thing that we would talk a little bit about in terms of New York is that this is the one state that had some increases in tax rates and surcharges, and some of these were supposed to expire before January 1 of 2024, but New York is extending those until 2027. So that's one of those states that isn't letting things going around. They also did put through some pass-through entity tax corrections and revisions if that applies to your business, just to be aware that that's out there. And then one of the things that's very interesting on kind of an appeal perspective is that New York, for all the prior years, probably I think the last 35 years, the department was prohibited from appealing decisions from the New York Tax Appeals Tribunal, and that was only one of a handful of states that didn't allow the department to appeal. But that good situation for taxpayers is coming to an end because they are now allowing the Department of Tax and Finance to appeal decisions coming from the tax tribunal, and the New York Tax Appeals Tribunals. So that's out there as well. Okay. So let's get to what we want to talk about with some of the developments, legislative developments, but also talk about things of opportunity and consideration for manufacturers. And one of the things that we want to cover is that these are exemptions that apply to manufacturers. These are not new exemptions. These have been in place for years and years and years, since manufacturing's been around for a long, long time, and just wanted to make sure that, folks are keeping in mind how some of these exemptions may apply to their business, and making sure that they're fully capitalizing on such exemptions. Also want to talk a little bit about where you do have filing obligations, identifying and understanding what those are and where those are, and then talking a little bit about, as we see the tax world changing so much, where more and more states are trying to pull in taxpayers with greater ease because of economic nexus. Primarily, how do you address any type of exposures that your company may have based upon these developments, and then also what type of solutions may apply to your company. So when we talk about manufacturing exemptions, there's a few standards that apply across the board generally, and of course we'll talk here a little bit about specific exemptions by state. There are some nuances, some differences between the states, but in terms of overall manufacturing exemptions, raw materials and tangible personal property always exempt from tax when they are incorporated into the manufacturing project, and just different products change and things like that, just make sure that the company is properly getting exemptions for all the raw materials and any TPP that's incorporated into your manufacturing project. Property and equipment used for administrative purposes is generally taxable. And there's always a difference of opinion between the state and the taxpayer as to what is part of the manufacturing process and what is outside, including things done for administrative purposes. So I'll always take a look and make sure that we're not missing something that could be considered part of the manufacturing process. The taxability of machinery, equipment, and supplies depends on the use of the property and the state's specific rules for the manufacturer. Like I said, that's where there may be some differences and some daylight between the states, but always look for that machinery, equipment, and supplies. Look at how that's being specifically used, and property must be generally used in the manufacturing process. Again, the key is directly used in the manufacturing process to qualify for exemption. So let's talk briefly about yes.
Is there anything that our manufacturers should do to document or ensure that those exemptions that they qualify for?
Yes. And one of the things I will distinguish, and we'll talk about this later, is when people talk about exemptions, we have these exemptions that are statutory that exists for the manufacturing process, and then there's also the exemptions for when a manufacturer may sell something and not collect tax because they're saying it's for the sale was for exempt purposes, and that's where you document things with an exemption certificate. So we'll put that aside and talk about that a little bit later. But in terms of this, I think really what is important is for a manufacturer to sit down and look at and document their manufacturing process, and in just making sure that there's nothing that they're overlooking. Could be there could be new equipment that has been purchased and put in place that people could be overlooking. There could be equipment that was obviously used and removed. So I think one of the important things for manufacturers to do is to kind of document exactly their manufacturing process, what's all involved in it from a perspective of equipment and supplies, and making sure that if it's not readily apparent, how they are used directly in the process, that you kind of make sure that's done from the documentation standpoint, because that will only help when an auditor does come in, to do an audit. Because at the end of the day, as I said, there's always going to be a tug of war as to, when manufacturing begins and where manufacturing ends. And obviously the taxpayer thinks it's a longer process, and the state always thinks it's a much shorter process. And I think then what a manufacturer should do then is then consider what the state specific manufacturing exemptions say in terms of what is exempt for the various pieces of equipment, supplies, the utility. So I think that's something that's very important for every manufacturer to have in place, and then to update as their manufacturing process evolves, based upon technology and different advancements. So I think that's one of the things, and I think a large core of that manufacturing process has the same taxability among states, but then there's going to be some things on the fringes where Ohio has such a broad manufacturing exemption as compared to another state that's more narrow. But I think just the documentation, Amy, is important, because I think it affords the taxpayer a complete understanding as to their manufacturing process. Then I think it also sets forth kind of something that an auditor has to kind of refute, rather than allowing an auditor to just come in and have there's nothing in place for them refuting them, just to say, hey, this is where manufacturing starts and stops. So I think that's really important from this exemption perspective. So let's just briefly talk a little bit about some of these exemptions that apply, and even believe it or not, with our offices in Florida, we do deal with manufacturing. It's not a hotbed state that Ohio or PA is for manufacturing, but they do have an exemption for industrial machinery or equipment. Applies to businesses that manufacture, process, compound, or produce PPP for sale. Basically, the repair parts and labor charges for mining, construction, manufacturing is part of this exemption process, and also the pollution control equipment and machinery, also when installed to comply with the DEP, is something that's exempt under Florida laws. Let's go to a polling question. So let's talk a little bit about New Jersey and some of their manufacturing exemption. And essentially, their production begins with raw material when committed to manufacturing operation, and ends when the product is in form sold to the ultimate consumer. And again, that's again, beauty in the eye of the beholder in terms of where it begins and where it ends. But that's how New Jersey looks at the manufacturing process. Direct use in production is use and transformation of raw material to the finished product. So again, you have to have something that's being directly used in production to make sure that it is afforded that manufacturing exemption. And then their perspective on supplies, tools, and parts with a useful life of 1 year or less is subject to tax. In the state of New York, in terms of the way they look at manufacturing exemption, production begins with the handling and storage of the raw materials and continues through point where the product is packaged for sale. Again, direct, you'll see that direct and predominant use in production is required to claim the exemption. And then they also look at parts, supplies, and tools are exempt if used directly and predominantly in production. Again, as I mentioned, Ohio, a state with a good, healthy, robust manufacturing exemption, and Ohio looks at the exemption for TPP use primarily in manufacturing when producing tangible personal property for sale. The process they look at begins when raw materials are committed to the process. And again, the storage of raw material does not qualify. So, a lot of times we'll have, questions as to, where do certain things fit in terms of the exemption process, and sometimes people will have forklifts, and that is used to move raw materials around the floor. And one of the things that we always say is part of that documentation is if you're trying to get something such as that piece of equipment exempt, make sure it's shown to be involved once the raw materials are committed to the manufacturing process, because if the state's left to it, a lot of things will try to push back to prior to that beginning of the manufacturing process. And also, manufacturing is broad, as I said, and generally includes the following when used in the manufacturing process. You have machinery equipment, material handling equipment, supplies that interact with the product, property to test raw materials of product, utilities and fuel used in operations, and parts and repairs. So again, as many of you know, Ohio is a state with a good, broad manufacturing exemption, and just keep that in mind, and always being willing to take a look at what you're purchasing, what you're using, and see how you can best try to qualify it for one of the exemptions in Ohio and any of the states. PA. In terms of the manufacturing exemption, they look for exemption for machinery, equipment, parts, and supplies directly used in manufacturing operations. Again, the direct use. From PA's perspective, manufacturing operations begin with the first production and end with the packaging of product for the ultimate consumer. So, when that is being kind of put for shipping and going to that ultimate consumer. And then manufacturing exemption includes proper use for pollution control in PA, testing and inspection, again, during operations, R&D, and then packaging. For that to qualify, that must be going to the ultimate consumer. That's been tested and adjudicated through many court cases. So let's talk a little bit about also nexus, and we talked just briefly about this, but whether you're a manufacturer or whether you're in some other line of business, this is the one issue I think that is a big challenge for companies these days, and especially companies that some of you may be owner operators of. And one of the reasons why this is so important is that it is so much easier these days to be subject to tax in another state. Years ago, we had the standards of physical presence. So hey, even though I'm selling into this state, we don't have any employee there. We don't have any property there. We don't go into the state for technical reps, things like that. We can always say that. But nowadays, because of the economic nexus standards, it is a lot easier to be subject to tax on the sales tax side, and then as you can see with some of the other taxes, be it income tax and gross receipts tax, things like that. But again, just keep in mind when you're looking back and trying to assess that, hey, I don't want any exposure where I've had years of a filing obligation in the state, and because I've never filed a return, the number of years that I owe never go away because there's no statute of limitation because the return hasn't been filed. I just want to kind of again highlight to you, and stress the importance of understanding, with your business activities that you have different type of nexus nowadays on the income tax side, and there's some states that are still sticking to the physical presence. You have property employees physically present in the state, and because of their business activities, that creates some type of minimum activity in the state that requires your filing of a return. Again, what's more and more challenging these days is there could be situations where you just have sales into the state, and as you could see, what I shared with you with New Jersey and some other states have done, a lot of states are imposing the economic nexus and saying, hey, even though you do not have that physical presence, you don't have an employee in our state, you don't have a business location, you don't have any physical property in our state, but because you have enough sales or you have basically enough number of transactions in a year in our state, we're going to subject you to the filing requirement. And the bottom line is that more and more states are looking to do that, and just try to see what legal challenges they may face if they do that. And then there's also factor presence nexus that we refer to, and basically the state will look to the business apportionment data and say that, hey, if you have more than a set amount of property, payroll, or sales in the state, then you're going to have a filing requirement. And just highlight this to all of you that it is easy these days to come across a situation where you may owe multiple years of taxes to a state that may not even been on your radar screen because we are used to the fact that we didn't have to file returns if we didn't have the physical presence. And like I said, in the past, there have been constitutional limitations, including Public Law 86-272, that basically gave you protection from having to file in a state where you only basically sold into the state, and then only business activity was the solicitation of sales. And as you can see here, this map is that more and more states are looking to impose some type of economic nexus standard. And I use the analogy often, for any of the sports fans, especially fans of college football or professional football. Once a team has success, whether it's with a particular offensive scheme or a defensive scheme, the next year many of those other teams are trying to put something in place similar to that to replicate the success that the other team had. And this is no different, I think, in state taxation. So as we saw, the roll up of all the states imposing economic nexus for sales tax, you can see more and more states looking to impose economic nexus for some type of income tax in the various states. And let me just again to try to close the loop here. With the sales taxes, this is what was created from the quill situation in 2018. You had one state South Dakota said, hey, even though you don't have physical presence in our state, Wayfair was the company, we think that you should collect sales tax on our behalf in our state because you have enough sales in our state. And that was basically the evolution of the Wayfair decision and why all the states now that have a sales tax are requiring the collection of sales tax, based upon a certain level of sales or number of transactions in the state. But that is what that was created by the sales tax situation. One of the things I want to stress to you, though, even though I'm saying, hey, physical presence is a thing of the past in the sales tax world because we have economic nexus. And you can see more and more states, even on the income tax side, looking towards economic nexus. Don't fall asleep on physical presence. So again, you may have a situation, and if you're a seller of taxable goods, don't fall asleep and say, well, we don't meet the economic nexus threshold. We don't have $100,000 of sales, or we don't have enough transactions in a particular state. Just keep in mind that the state still will look towards, physical presence and saying, hey, even though you may not have the economic nexus, you have something else in our state, and that we list some of the different factors that could create physical presence, delivery, and company vehicles. You could have representatives, including third parties, going into the states. You can have people performing services, in addition to you having other type of physical presence in the state. So just be aware that always does apply, even though the states are looking to create nexus through economic means these days. And I shared with you a little bit about Wayfair here in 2018. And one of the things want to stress here for you is that one of the things that you have to look at is that the states are really serious about this. And one of the things that I was alluding to here about owner operators is you just want to make sure that that you're not missing a state where you should be collecting the sales tax in. And one of the things that is unfortunate is a lot of times that the states will not be forgiving if you haven't collected the sales tax, even though you were just doing a fiduciary responsibility of collecting the sales tax from your customer and passing it on. If that is not done, we're seeing some taxpayers with some significant sales tax exposures because they're not thinking of all the states that they should be collecting the sales tax in. But one of the things we want to highlight to you here is when we're looking at the economic nexus considerations is, making sure, hey, what I'm selling in the state is, or the service that I'm providing, is it taxable in that target state? And it depends, and that's one of the things you should take inventory of, what state you have sales going into, and is that product or service taxable? One of the things want to also highlight is some of the states count non-taxable sales against the thresholds. But some do not, and you just have to be aware of what states are counting taxable only, or including non-taxable sales for the economic nexus threshold, and just understanding what is that potential liability in the target state, and making sure when you're taking this on that there's more states to account for on the sales tax side. Is your ERP system of capable of adding more and more states to the sales tax compliance. The other thing that I wanted to highlight and coincides with Amy's comment on the exemptions. We had the we talked a little bit about the statutory exemptions for manufacturers a little bit earlier. But one of the things that does come into play here too is, a lot of companies, including manufacturers, will say, hey, I don't have to worry about this because, I'm manufacturing and it's an exempt product a lot of times. One of the things that you want to make sure is whatever you're selling and you believe is not subject to tax, make sure it's not subject to tax by collecting, a proper exemption certificate. So when a customer is telling you, hey, do not charge me tax because, it's exempt under, whatever reason it is, make sure that there is proper documentation and maintenance of that exemption certificate, because the states, when they do come in, they very well may know that what you're selling is not exempt, or what you're selling to a particular customer is not exempt. But if you don't have that proper documentation in place, it's just they're going to simply overlook that and subject that to tax. And there's a lot of questions when you're trying to expand that footprint in terms of what you're subject to for sales tax compliance. And just know that in many situations we're seeing more and more taxpayers that have significant increases of sales tax responsibilities. Let's go to our next polling question. And let's talk briefly with the time that we have left here. Let's highlight a lot of different things. Is that there is a likelihood of increased filing obligations, on the income tax side, and clearly on the sales tax side. And one of the things that we mentioned to you when we talk about making sure that you don't have significant exposures for a business, and as I alluded to, is that when you file a tax return in a state, typically the state has a 3 or 4 years statute limitations, and you can breathe a sigh of relief when certain years returns go past that statute limitation. One of the challenges is be it any type of tax, if you've not filed a tax return, that exposure never goes away. It just basically builds up over the years. With each year that goes by, you have the tax, you have the interest, and you have the penalty. So one of the things that we always talk about is get your hands around where you should be filing, and we'll talk a little bit about that in the next slide. But just be aware that there are states that offer what are referred to as voluntary disclosure agreement with taxpayers if they have not been contacted or registered. So a lot of times, you may have a taxpayer that owes 10 years of returns, and basically we can reach out to a state and say, hey, we're bringing someone forward that wants to address these exposures. And a lot of times the state, if there's been no prior contact with notices, there has not been a registration of that company in the past, a lot of times they will accept that under a VDA, and basically you can limit the number of years you file usually to the statute of limitations. So in the example of 10 years of exposure, in PA, you may only have to file 3 years of tax returns. And then a lot of times we'll get the penalties abated, and then you'll just owe the limited years of tax and interest. So that's something that we often will point to. The other thing that we will also say is, hey, pay attention to when states run amnesty programs. And this is also a situation where a taxpayer can look to, minimize the exposure that they have in the past, because it's a way to button it down. And like I said, when you're not filing the returns, those exposures are never going away, and they only cause headaches when you're ultimately looking to try to sell that business somewhere down the road. In terms of the SALT opportunities, like I said, the nexus analysis, that's getting your hands around where should I be filing for sales tax, income tax, gross receipts tax. and paying attention to, taxability. Am I properly charging tax on, all the things that I'm selling? And on the flip side, am I getting overcharged tax on things that I'm purchasing? Keep in mind the manufacturing exemptions that we've talked about, and also, consider also the compliance end of things. We're working with more and more companies on the sales tax compliance because of that significant increase of time that has taken a lot of companies because of the increase in number of states where they're filing sales tax returns. And also keep in mind now, with states coming out of COVID is, more and more departments are sending the auditors out on the audit side, and just keep in mind that not always just accepting the auditor's decision as to what's taxable and what's not. And like I said, we work with a lot of companies in terms of appealing the various audits. And then keep in mind also on the flip side, when you are getting an audit, there's no better time to conduct a refund review and identifying where you might have overpaid tax on some of your purchases. And like I said, even though an auditor is required to properly assess, what your tax situation is, for whatever reason, they seem to be only focused on the assessment side of things. With the time that we have left here limited, just wanted to highlight too is that there's a lot going on with pass-through entity taxes. That continues to be a big area where states are trying to address that SALT cap limitation. And what I wanted to show you is that there's basically 30-some states that have something in place. One of the states that continues to be, not having a situation to address pass-through entity taxes remains Pennsylvania. There was some thought that, if they got their act together with tax legislation this budget season, that there might be something coming out. But the way things are, there definitely seems to be a delay with that happening. As you can see here on this map, that there's 3 states that would propose the PT tax bills that includes Pennsylvania. And then just very briefly, just let you know that there's a few states that have enacted PT legislation, including Indiana here, Kentucky, North Carolina, Virginia, West Virginia. And that brings us to the end of our presentation. I know we covered a lot in an hour, and like I said, if there's any questions that arise after this webinar, feel free to reach out to me, any of our SALT team, or your HBK point of contact. And thank you for your time today.
Thanks so much, Tim, and we appreciate everyone joining. Obviously, we went through those last slides pretty quickly, and you can see that there's just a ton of activity happening in the state and local environment right now. As Tim mentioned, please don't hesitate to reach out to any of his team members or Tim, as well as Jim DeCenzo or myself if you have any questions for our Manufacturing Solutions group. In addition, the slides will be available on our website and in a follow-up email for you. Again, thanks everyone for attending, and we'll see you next month. Have a great day.